Part 2 starts now. We left off with the fact that we found that in this particular problem, the comprehensive illustration problem of Chapter 4 was done on a initial value method, and we need to do what I said in class, and that is move the investment account only on the consolidation worksheet, not actually in the books of the parent, to the equity method balance. Now, we could actually do it in Father's books, that's the name of the parent in this case, if we were the accountants for Father, and if we're doing the consolidation, we probably are, so we could do it there, or we can do it on the consolidation worksheet. It's really our choice. If we do it in the books of the parent, then it's actually saying that it becomes an equity method investment problem where we've made the adjustment. But for illustration purposes here in this comprehensive problem, we'll just do it as the consolidation worksheet, which is enlightening by itself. So let's see what we do. We are attempting to do the year end for 12/31/15, and since we're going to be doing the activity for that year, we really are concerned about the opening balances. That's the A entry, as well as other entries are mostly concerned about the opening balances. So that's why we're going to now be concerned about bringing up to date our investment account on Father's books on the consolidation worksheet only to the equity method. And the way to do it is, since equity method we learned, do you remember how I said that why it's called the equity method is because we're following the change in the equity of the subsidiary? So indeed, we're going to look at the change of the equity of the subsidiary during the years in question. Where were you on the night in question? Well, that's a different textbook. This textbook is concerned with consolidations. So, what happened to retained earnings during that period of time? Let's see. The subsidiary's retained earnings increased during that period of time by 180. How do we know? Well, we know it started at 300. That was given in the problem. That was in 2011, date of acquisition, and 1/1/2011 to be precise. And then we see, just so you can see, let's go back. We can see that at the, make some room here, at the end of 12/31/15, or actually better yet, at the beginning of 12/31/15, meaning 1/1/15, it's given right here. Here's the retained earnings in the subsidiary company. So we go back and we say the difference has been 480 minus 300, or $180,000. And now what does that all mean? So let's see. First of all, that difference, that 180, is for the whole subsidiary company, 100%. Our guy, our father company, our parent company, only has 80%. So had they been following the equity method, they only would have adjusted for 80% of this. So we'll start there. 80%. That's an interesting sound effect there, by the way. Let me do that. I might do that again. Somebody stop me. All right. So 80% of the difference is 144. Now that's great for the books and of the subsidiary, of what it did with income and what it did with dividends. It takes it all into account, because remember, the retained earnings is going to take into account the income amount and the retained earnings, and the dividends coming out of retained earnings. So this is great. It gets us where we want to be, except for one thing. It doesn't take into account the equity method adjustments that would have been made for the difference between fair value assets and the assets at book value. In other words, this schedule, right, where is it? Where's that schedule? Where's that schedule when you need it? Okay, here it is. Let's make some room. It's this schedule I'm talking about, where we have the differences between fair value and book value at date of acquisition. And then, of course, we did the year-by-year amortization on this schedule. We learned that the net book value is going to be this at the end of 1/1, or at the beginning of 1/1/15. This is going to be for the A entry, but what here we found is $6,500 a year is the amortization. So you go back here, so the adjustment's got to be $6,500. Oh man, look how cool this is. $6,500 at 80% for 4 years to give us what the equity method would be by taking this computation, and in this case it's additional depreciation, additional amortization. So you're going to take, watch this, You can take your 144, which is your increase in the subsidiary's equity at 80%, and then you're going to take the amount that this calculation comes to, which turns out to be 20,800. You're going to take that amount and subtract it because it was additional amortization, additional depreciation, and you get, what do you get? You get this number here, the 123,200, and that's what you need to bring the investment account on the books of the father into balance of what it would have been had they been doing the equity method. All you did here, I'm going to make some room so you can read it on your own. All they did was figure out what the investment account would have been had the equity method been followed for the 4 years leading up to 1/1/15. And that allows them to do the first entry for the consolidation, which is here. Here's that number, 123,200, debiting the investment in Sun Company. Because remember, on the books of the father, they showed it at initial value. They made no change. On their equity method, it would have gone up. How much would it have gone up by? A net of 123,200. That's what we just did. We just did actually 4 years of equity method application by using net additions to retained earnings when they're part of the subsidiary. They could have been net reductions, whatever the net change was over the 4 years. That's what we've done. And we've adjusted it to the parents' retained earnings, their opening retained earnings, very important, their opening retained earnings. This will all be part of the consolidation entries on the worksheet. So this is entry number 1, or as they call it, entry C. The C, I'm not sure what it stands for, but it's a pretty good entry to bring us into balance with the equity method for the investment account. That's what we've basically have done. Yay, yay, yay. All right, let's go forward. Here is the calculation. This is the calculation of the non-controlling interest, which we also need for the worksheet. You need to really kind of study this on your own, but I'll go through what they're really doing. What they're doing, it's almost the same thing that we just did to get into the equity method, same kind of concepts. What they're looking at is the book value at 1/1/15, which we got from the balance sheet. That's in the problem. Look in your textbook to see it. The subsidiary's initial book value, and it was composed of 100 capital stock plus the 480 opening retained earnings to get the 580. That's how this 580 is there. And they know that 20% belongs to the non-controlling interest. So 20% of this number is the non-controlling interest at 1/1/15. That's what we're trying to get to. What's the opening non-controlling interest? Of course, this is book value, and we've got the adjustments that have been occurring on a consolidated basis every year. What adjustments are they? They are the adjustments due to the fair value excess that we saw when we first set up the problem, way back to this slide, all of this, and this translated really nicely into this slide. I'm going to again clear the deck for illustration purposes. This translated very nicely into this amortization schedule, but note that 15 of this, 20% of it did not belong to the non-controlling interest. How did we know that? Because we looked at it down here, and we determined that down here, the actual goodwill is control premium goodwill, so it doesn't belong to the non-controlling interest. So of these numbers, 15,000 doesn't belong to the non-controlling interest. So what we're going to say then is of the 1015, take out 15, and you'll get 86.5. So it's 86.5 is what we need to think in terms of the total adjustments of fair value over book value, because all this schedule is at 100%. Like this is at 100%. Remember, this is at 100% too, because the consolidated statements are 100%. This is all theory that we've gone over before. But how does that work here? that works here from the standpoint of the 86.5, which is that differential we just saw, not including the goodwill since that goes to the parent. 20% of that has to belong to the non-controlling interest as well. What is it that we're talking about? Again, let me describe it this way. This slide shows you, if you take out this, you get 86.5. That means at this point in time, 1/115, the balance sheet on a consolidated basis should have an increase in assets by 86,500. Remember, this is the excess amortization and the excess amount of value. After the amortization, we started with this number, but after the amortization over here, we should have this. So this will be our A entry, booking up the assets. Which assets? All of these, except for the goodwill, in this analysis, since we're only concerned about the non-controlling interest right now. We still will book up the goodwill for the controlling interest share, but for the non-controlling interest, goodwill doesn't come into play because it doesn't belong to the non-controlling interest. So our A entry from a non-controlling interest standpoint is only concerned about this difference. This is the book up at 1/115. Again, after the amortization, from here to here, the net is 86.5. That means that of the non-controlling interest portion, this is the book value, but we have to add the net differential, and in this case it's 20% here, or 17,300. And all of this, even though it sounds complicated, really is not too bad. Gives you the opening non-controlling interest portion for purposes of your consolidation, so you know where you stand. And then, of course, the information given to you allows you, let's make some room, the information in the problem allows you to figure out how this is going to change from beginning to end, because this is your beginning, and then you're going to know this is the income that belongs to the non-controlling interest, this is the dividend belonging to the non-controlling interest, and this is how the non-controlling interest should end up. How do we know about the income? Well, we'll see there. We'll get there, but a little bit more. But they show you how to figure it out through here. But we'll get there. All right, let's hold here, and we'll come back.